Hi and welcome to Swissquote's Daily Market Talk. We are Wednesday, the 1st of July. Markets entered the second half of this year with remarkable momentum despite months of geopolitical tensions and also an energy shock. AI-driven investment continues to fuel equity gains for now, with chip makers leading the rally, while lower oil prices since a couple of weeks now are easing inflation fears around the world. Last week's technology fear has also evaporated for now, so it is in this festive environment that markets' attention is turning toward the US labor market data and Fed Chair Kevin Warsh's speech in Sintra in Portugal, where markets expect continued emphasis on price stability. On the other hand, rising US yields may challenge equity valuations, but robust earnings expectations and abundant liquidity continue to support risk appetite. So we will talk about that and more, but before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the first half of this hectic year, marked by severe geopolitical tensions and an energy crisis, ended on an exceptionally strong note. The S&P 500 printed nearly 10% rise in the first half of this year. The STOXX 600 gained more than 8% and closed yesterday having hit a fresh all-time high level. Then the Japanese Nikkei index is up by 40% since the first trading day of this year, also supported by a softer Japanese yen, while the Taiwanese TAIEX gained up to 60% and the Korean KOSPI up to 100% thanks to two chip makers there, memory chip makers Samsung and SK Hynix. Then spike in oil prices had a very short impact on global investor appetite in the latest quarter. The AI optimism fueled the indices higher. The chip makers were the biggest winners of the quarter. The big technology stagnated on fear that the massive and increasingly leveraged AI spending wouldn't lead to satisfactory return on these investments in a reasonable timeline, while the software companies swung between the fear that artificial intelligence would kill their business and, on the other hand, on hope that increasingly expensive tokens to replace human beings wouldn't fully replace them at the end of the day and nor their existing services. So today, 3.5 years after ChatGPT entered our everyday lives, many agree that AI increases our productivity significantly, that it will be deflationary in the medium to long run, but in the short run, as in all revolution, the latter means an important transition that is costing many people their actual jobs, unfortunately. But in the US, for example, the latest jobs data has been much less catastrophic than the layoff headlines suggested, perhaps due to job creation for the massive AI built out, but also the temporary tailwind from the World Cup at the moment. Released yesterday, the latest data show that the US job openings were slightly higher in the month of April, but hiring was also slow. Then other piece of data also hinted at some improvement in consumer sentiment in the US and also in terms of expectations thanks to a hypothetical peace deal between the US and Iran, which would keep oil prices lower in the coming months. And the good news is that the US crude consolidates below the $70 per barrel level again this morning, keeping inflation expectations globally in check as the new Fed Chair, Mr. Kevin Warsh, is about to speak in a central bankers meeting in Sintra in Portugal. Now note that his arrival to the Fed marked a clear and an important restatement of the Fed's policy priorities. He set price stability as his major priority, remember. So today he is expected to emphasize the importance of the price stability as the US labor data points at slowing but not an alarmingly weakening trend in the jobs market. And later, the focus on keeping inflation in check will likely continue to push the short end of the US yield curve higher and could eventually lead to a flattening curve with softer pressure on longer maturity yields in the US, as a tighter monetary policy today should have an easing impact on longer-term inflation expectations. So how will rising yields on the short end of the curve impact impact US indices is to be seen. The earnings expectations, on the other hand, are strong enough for investors to absorb higher yields when inflation expectations are also easing along with easing energy prices. But anyway, today the ADP report is expected to print 118,000 new private job additions in the US in June, while tomorrow's NFP data could print a similar number with steady-ish wages growth. So figures in line with the market expectations would reassure investors and the markets globally that the situation in the US, especially in the labor market, is steady, while inflation again is looking better, not only in the US but elsewhere as well. The pullback in oil prices will be reflected in next month's inflation numbers around the world, as the oil shock hasn't been long enough to echo through the rest of the economies. We already saw a certain pullback indeed in the euro area's preliminary inflation numbers for June earlier this week, and today's aggregate CPI read for the euro area should confirm a pullback in the euro area's headline inflation to 3% from 3.2% printed a month earlier. So that's a welcome development, of course, but the European policymakers continue to warn that the energy crisis may not be over and inflation above the 2% policy target needs to be carefully handled in the coming months. In concrete, the European Central Bank is still expected to hike its interest rates one more time before this year ends, but growth in the euro area was anemic before the Iran war started, and the economic outlook has deteriorated since then, with the first quarter GDP data, remember, turning negative. Therefore, if inflation shows signs of easing in the euro area, the ECB could hardly justify more rate pain on the underlying economies. As such, the euro-dollar's upside attempts against a broadly stronger US dollar today remain easily countered by the hawkish Federal Reserve expectations and the strength of the US economy that, in contrast to the euro area's contraction in the first quarter, printed a 2% growth in the first quarter of this year. And the US dollar's strength is seen growing in the coming months, an important shift to the early de-dollarization and debasement trade, mind you. But that being said, there were actually many factors other than the Fed that led to that debasement trade since the return of Donald Trump to the White House last year, including the rising US debt, an unsustainable fiscal policy, the trade tensions with major, not to say with all, trade partners, and geopolitical threat that the US has been posing on historical rivals but also on historical allies. The latter have not changed. The only thing that changed is the Federal Reserve's policy outlook. So I believe that the US dollar in this context will continue to appreciate against most majors on its rising yields and the rising rate differential, but the long-term trend of de-dollarization, debasement, will not change. The latter could lead to a slower than otherwise US dollar appreciation across the board, and as such have a softer negative impact on US equities as well, and also on inflation outside the United States. But what's clear today is it has become totally unreasonable to turn bearish on financial markets when the bullish tide is so strong. In fact, we have barely seen any durable pullback in market prices over the past years, and that's thanks to AI and very strong liquidity support across the global financial markets. And the latter is not ready to change at all. So as liquidity flows in, it should go somewhere. You can call it stock price inflation, or you can put it on the back of strong earnings growth and even stronger earnings expectations, but the market's direction remains tilted to the upside. So the best thing to do is to stay invested, diversify, and benefit from the valuation gaps where it is possible. There will be corrections down the road, obviously, and the technology-related volatility today is high enough to bring in some impressive market moves, and the thin summer trading volumes could also exacerbate the market and the price action, but the overall outlook for the global financial markets remains bullish for the weeks to come. Now, last word on gold. The yellow metal continues its decline below the $4,000 per ounce psychological mark. The bears are supported by a broadly stronger US dollar and rising US yields as well. A pullback could continue toward the $36.80 per ounce level, but that level will make gold interesting for long-term buyers who are looking to better diversify their portfolios. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.